Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Is the AI U.S. market rally overdone, or is it just getting started? And is this concentrated performance driven by a handful of stocks truly sustainable? For investors seeking broader economic representation and diversification, the rest of the world may offer compelling opportunities. Joining us here today to share his perspective on the less crowded, lower expectation markets of Europe, China, elsewhere as well, is Portfolio Manager Patrice Quirion. Patrice manages several Fidelity funds, including the Fidelity International Concentrated Fund and the Fidelity Global Fund. Welcome. So glad to see you. How are you doing?
Pleasure to be here.
Delighted to have you here, and we'll dig into all of those pieces, including a peace dividend, but we'll get to that in a second. You've been doing nothing but being ahead of a lot of international trades over the course of the last little while. It's been nothing but international for the first 6 months of this year. Is that it?
I don't think so. Those trends, I like to bring everything into a framework where most patterns will follow some sort of cycle. There are short cycles and there are long cycles. The short ones, everyone's paying attention to. The long ones are easy to get overlooked or to get confused with like a secular trend as opposed to a cycle. And what I've been talking about for like over a year now, well over a year, is that I think we are getting to this point where the U.S. economy, its consumer, its fiscal spending, its corporate spending, is starting to look somewhere close to the peak of its cycle. Those long cycles last a long time. As a result, it's hard to have the perfect timing on exactly when that changes. But I think this is the picture. But what's interesting is you look elsewhere, you look in Europe, and especially you look in China, and you can start looking at same like main economic players, the consumer, the fiscal side, the government, and the enterprise or the corporate sector are all closer to a bottom or maybe a little bit more like mid-cycle in Europe. And those eventually revert. And you need a catalyst for it to revert. It's really hard to tell when the catalyst happens or had happened. But I think if you try to invest with a longer term horizon, which I do, I try to bring it back to that framework. Because those cycles, they don't last like the first 6 months of this year. They last for like a decade. And we've had a lot of those over time. Like it was oil in the 80s, Japan in the 90s, like the internet bubble in the 2000s, and you had China and commodities, and now we just had the US. So is it turning, or as it turned like November 2024? I can't guarantee you that. It's really hard to guarantee anything. But you look at how the markets are behaving, and it feels like we have basically turned a corner back then. I think you're seeing it from a different viewpoints. Like the performance of China and Europe was really good. Q4 last year, Q1 this year. And then we had Liberation Day in early April. And after that, the market took off. And it was led by the NASDAQ. But if you skim through the market in the US, like the S&P 500 has done well, but it is so narrow once again, especially in the US market. Where if you take like a broader representation of the US economy, take like the S&P 500 equal weighted, or take the Russell 2000. And those like broader indicators, in my opinion, than the NASDAQ or the S&P 500, is still lagging even on that like US recovery post-tariff is still lagging the rest of the world. And pretty much everything. It's lagging China, it's lagging Europe, it's lagging Japan. And I think and I feel a lot of people are not really paying much attention to that or not talking a lot about that. But the fact that you just had like this massive relief rally that I think is potentially more than just that. I think there's a lot of momentum, fear of missing out.
You're talking about in the US specifically?
On that rebound in general, but it's much more acute in the large cap tech trade, which is mostly in the US. But yeah, despite that, like the trend underneath the surface, I think is still intact or continuing, if we can put it this way. So to answer your question, I think there is more to go on this. Will it be of the magnitude of what we've seen in Q4 and Q1? Very unlikely. Like when you hit those inflection points, assuming this is one, those inflection points like convergence are very abrupt. They happen quickly, large magnitude, but usually they last. And what gives me the confidence that it can last is back to that sort of cycle framework. We are still there. Okay, maybe the market's a little bit more optimistic about Europe rebounding from like German like fiscal spending picking up. But this is not the big story. The big story is if you need to, if we were to, and like follow cycle, we will. The question is when. Is it now? But if you get like a broad reacceleration of those economies, like in most of the rest of the world, which are kind of like scraping the bottom, it's going to be much more than one sector. It's going to be broad. Like you'll get consumer confidence coming back. You'll get like supportive fiscal spending. You'll get corporate spending following that. And it will last a long time. And the same thing, like if we were to ever, and I think we will, deflate this like AI boom, like data centers, semiconductors, GPU, like electric power need, like all of that is so correlated in the US. Ever starting to be questioned on, not question will it happen, question on is the pace on which we are sustainable.
And is it overpriced at some point?
Yeah, exactly. I think the benefit of that international diversification, which, I mean, from a diversification risk management perspective, I don't think anyone doubts that there's always a benefit to that. And by the way, it's not only like geography, it's within sectors, it's within investment style. There's always merits to be like more broadly like positioned. But I think what people forget, or what people in a lot of cases like have been accustomed to, is that cost of reducing my portfolio risk by being into sectors that have not done as well, or in countries that have not done as well, is it drags my returns down. And I think we might be at this point where maybe that diversification, like not only like reduces your overall risk and reduces, I think, what is becoming like an overexposure to one big like AI thematic, but it's not representative of like the world economy in a way. I think we might be at this point where there will be benefits also for the returns of your investments to be diversified away from it. So
if you're mentioning 2024 last year, this is in Q4, actually China went mad. A couple of the huge companies just caught a wind, and it was a massive leg up. That was something that you've been interested in, I think, all through that. You caught that, basically. Mm-hmm. And then through the beginning part of this year, it was Europe. It was all Europe. You also caught that. I guess the question is, in terms of positioning, do you come back to the U.S. a little bit?
Yeah.
How do you look at that?
Yeah. So just to put that in perspective, I caught that, but it was more pre-positioning. On my framework,
it's a bit crude the way I put that. Sorry. Yes.
On my framework, those are the areas that look mispriced. Like the market has sort of given up on some of these companies, and it provided good opportunities. It was hard to tell exactly when it turns, but when it turns, I want to be there before it turns. I try to pre-position the portfolios, trying to take advantage of those exaggerations that the market creates. And there was a lot of that last year. I still think there's a fair bit of that today. Less extreme. Yeah, I think Europe is looking less mispriced than it was, to be fair. I still think it's more compelling in a lot of cases, lining up like a US multinational versus a European multinational. The European stocks tend to still trade at a discount. And again, we're still lower in that cycle. But it's not as extreme of a divergence as we had last year. So how do we adjust? How do we like adapt when we get big movements like what we've seen in April, for instance? The bottom line, the portfolio is still in majority still positioned the way it was. Back to my point, it moved. Maybe it feels like a lot in like the 6 months, but I don't think it's the end of it. So the portfolio is still there. I think we need to be nimble and try to take advantage of some of the big moves and readjust our weights. So in April, what we've seen with Liberation Day, like the big tariff shock, it may come to a surprise to a lot of people, but not truly a surprise when you understand how the market works. The stocks that came down the most during that week, more or less, are not the companies that were exposed to tariff the most. The stocks that came down the most were the most crowded long positions.
That people could sell and make money and get out.
Exactly.
Right.
Where the faster money is, where like when it's risk on, you buy this. When it's risk off, you sell it as fast as you can. And that was in tech. And as a result, like one of the biggest drawdown in terms of sector was the technology sector. I remain careful. We could go as far as talking about like analogs between what we're seeing on AI now and what we saw with the internet in 2000. I'm still very careful on the hardware piece of like that massive like build out phase that we are now.
The picks and shovels piece?
Yes,
Yeah, okay.
But there are some great like software companies that I would love to own that were just too expensive, too high expectations. But that April gave us that opportunity to buy. So if you look in the top 10 of the global fund, you'll see Microsoft and Alphabet now showing up in the top 10. It's not from last week, it's from back in April, where I think these are more that like, software, and they are AI exposed to some degree, but I think they're more on the application side or the cloud side. Not to say there's no risk, but I think the price got right at that point. Our stocks have rallied massively, so something that I am considering again. Like, does it still make sense? And clearly it makes less sense than it did 3 months ago, but they're still in the top 10 as of latest disclosure.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Coming back to what you said at the beginning, that sometimes these big shifts happen over possibly a decade, and you were giving some examples of that. What is, if this was the turning point, if you caught it a couple of times, you're still there, and you're telling us that this might be the piece where the diversification comes in for a very concentrated U.S. market. What does everything else look like? You've mentioned China, you've mentioned Europe. Those are just two areas. We also talk about other parts of EM, for instance. Maybe the Middle East. I don't know. What is an interesting place that you're looking in now for later?
Those remain the two main areas. Like we can talk about smaller geographies. In general, they won't have as much of an impact. Japan is still meaningful from an international context. I think we need to be very selective in Japan. I was there a few months ago. I think there's opportunities around like improvements in corporate governance. I think maybe the biggest opportunity is around financials now that we have inflation that appears to be sticky, interest rate expectations that appear to be anchored at potentially too low of a level, including a BOJ, a Bank of Japan, that is still, I think, very hesitant to raise rates sufficiently, still afraid of deflation. I think all of that has the potential to accept the new reality of maybe a permanently like inflationary environment in Japan. And if that happens, rates are going to go much higher than the 50 basis points we're at today. That could be positive for the banking sector. So this is one area that I've been spending much more of my time since, call it the beginning of the year. If we go in the rest of the world in emerging markets, I mean, there's always opportunities here and there. The reality is none of them are really that big in the global construct to move the needle in a material way. There are some bits of opportunities in Southeast Asia, a little bit of exposure in the portfolio, mostly around like the consumer there. A little bit of like commodity exposure through like Australia, where there's a little bit of exposure in the portfolio. But yeah, I think let's think about the world as really it's the U.S., it's Europe and China, and then you sprinkle a little bit of other stuff, but this is not what's going to make the difference at the end of the day.
So within Europe, one of the things that's getting discussed, because there's this massive summit on Friday between Putin and Trump, no one really knows exactly what's going to go on there, but there seems to be some hope and some prospects for a path to peace in Europe. what would that mean? This is essentially talking about the reconstruction of places that have been war zones.
Yeah.
And certain companies will benefit from that. Are they big companies? Are they small companies? Is this a regional opportunity? Is this like a global multinational? How does it fit?
Yeah. So part of the story around what could further improve the sentiment and the fundamentals ultimately on Europe. We don't feel it here in North America, but the conflict in Ukraine still weighs quite a bit on consumer confidence, corporate confidence. Still like an energy price premium in Europe as a result of that. And there is also a market discount that's still in place, I think, not exclusively for that, but partly because of that. And we saw what happened like early this year where there was hopes of coming to some resolution, like Trump had promised like a quick resolution on that. Obviously, it didn't happen, but I think it depends what your time horizon is. Like if your time horizon is the next month, I cannot stand here and tell you this will get resolved. But if your time horizon is the next like 5 years, I think the odds of that conflict getting resolved is fairly high. And the fundamentals will improve, but the first benefit will be like sentiment on Europe from an investor standpoint will improve. The euro might improve. Okay. So there will be like short-term benefits from that. Is that what I'm looking for? Not really. What we're looking for is always like company analysis. Which companies will benefit from the implications of like peace? So reconstruction of Ukraine, maybe reduction of the energy price premium, maybe broad like consumer confidence improvement. And the good news as well, like in Europe, like the defense thematic, for instance, this is really well appreciated by the market. I think this is in the share price. You can't buy those companies saying defense spending is going up. Like everyone knows that. But what you can probably do is buy European construction companies or like consumer, somewhat discretionary companies where, because it's still somewhat uncertain of like when will the economy get better, when does the reconstruction will pick up, as a result, those stocks are not trading on like very high expectations. So if things get better, the stocks should do better. It's not all in the price. And this is mostly what I'm trying to do. It's usually more on the smaller company side.
Okay, this is super interesting because this is not a multinational story necessarily.
Because the reality is, if you look at the multinational, be it in Japan or in Europe or in the US, by definition, they sell everywhere across the globe or in most places across the globe. And it's really hard to buy them saying, oh, I will get this exposure to construction in Eastern Europe or Germany picking up, like because the exposure is going to be like de minimis. Right. But if you can find that local construction company, that local chemical company, that local bank, that local like whatever, like apparel retailer that might benefit from like improved sentiment, then you can have much more of an impact on the portfolio. But you need to go find for it. You need to do the work, like what's the risk reward on that, what's priced in, what's not, what's the exposure, what's the potential benefit. But you can do it, as opposed to if you just say, oh, I'll buy Europe, I'll buy like the MSCI, like EFI index or MSCI Europe index. Well, then you end up with like a bunch of big pharma, like a bunch of like big...
Like I said crudely before, you saw what was happening in China and you caught it and you said, well, I caught it because I had done the pre-work.
Yeah.
And that's what's happening now.
It's always our job.
For the European discussion.
And I think a lot of that work, like in my case, in our case at Fidelity, a lot of that work has been done already. Sure. Like for me, I'm waiting for that to happen at this point. And we're just doing our work in other areas. Now, maybe that will come a little bit as a surprise to some. Like it's not in the portfolio, so I don't want you to draw conclusions, but where I'm spending more of my time is on U.S. consumer stocks that there's a fair bit of them where things have been tough for a while. Like I know you look at the S&P 500 and you conclude, oh, everything is great. But back to my point earlier, you look at like the Russell 2000, it's been challenged for a while here. And there's pieces in that have been more challenged than others. And I'm not saying like this is a time to buy like all of that, but this is the pre-work that we're starting to do, that we set our prices where we're interested so that we're ready.
Wow, that is absolutely fascinating. There's a couple of questions coming in. I think you sort of answered it earlier, but are you seeing opportunities in South America? Argentina, Brazil. I think you said no, but just why not?
Yeah, looking for opportunities. Brazil is going through like a very important, interesting period where, the fiscal story, the fiscal deficit story, is going to be potentially a global problem, and Brazil is one of those countries that is suffering from it, like at the moment in the past year, and becomes an increasing question mark. So we've seen like interest rates moving up to, I forget the exact number, I think 14% or something dramatic, despite inflation not being a big problem. This is potentially, if you invest for the next quarter, it doesn't matter. If you invest for the next like decade, which I think should be the case for most people, we need to start being very careful about those fiscal, looming, growing risks on, sadly, the vast majority of countries. So Brazil is in the heart of that right now, which makes things more difficult. But if we can find companies that are not so exposed, and it's hard because then like the government may need to take like extraordinary like taxation measures to bring like income. So I'm not exposed there, but on weakness, I'm interested. But this is not where I'm spending a lot of my time. In South America, places like Argentina, there was a lot of hope that things could change.
With Milei.
I think there's still some of that applies. And I think especially on the commodity sector, it's a country that desperately needs to export to get US dollars in. That's the source of the problem of a lot of these emerging market like episodes or failures over time. They just import too much things, don't export enough. Argentina is filled with natural resources. There's opportunities to export some of that. In the past, there was no framework, legal framework, tax framework to attract foreign interest to develop it. Now we are. And there is actually one portfolio company. I own Lundin Mining, which is a copper producer, mostly in Chile, but they have a big project like potentially going ahead in Argentina. So yeah, there are ways to play, but again, this will always be at the periphery of what's really happening between US and China and how Europe fits into that.
And who ultimately gets some of those contracts, one side or the other. Yeah. Let's talk a little bit about the discussion of big versus small. This is the size of the companies themselves. You talked about it for Europe. Mm-hmm. Something more local and a bit more nimble could really see a catalyst and be able to run with it. Yeah. On the flip side, when you look at multinationals in this trade environment, there's a discussion of all kinds of pay to play within the US economy. Mm-hmm. So if you're a multinational in Europe, to then have access to the US, there's some pay implications. And even if you're a multinational located in the US and you want to do business outside, you also get kind of dinged both ways. I'm just curious how you're looking at, I know individually, but the small versus large companies that may just have less tariff issues. Yeah.
I would address that question in two ways. I think in general, if I was to pick more of like a small or mid-cap exposure versus a large or mega-cap exposure as a style factor in a way in the portfolios now, I'm much more inclined to go on the smaller side as opposed to the larger side. I think the really valuation differences are like large cap tends to be more expensive in recent years. It's not always the case. And now I feel it's exaggerated. Part of it is because the construction, like it's back to that maybe high expectation, high valuation, like crowding in the tech sector. That's part of it. But it's not the only part of it. Like even if you go totally outside of what I just described and look at large cap retailers versus small cap retailers, there is what appears to be an unusually high premium on the large cap side versus the smaller companies. So my portfolios tend to always be more, I'm totally market cap agnostic. I can navigate across. I have a little bit of exposure to all. But especially in recent years, I've been much more tilted towards, like, call it the mid cap range, like the 5 to 50 billion market cap type of businesses. I think more of them seem cheaper, more mispriced. But the most important point is easier to find, call it like idiosyncratic stories within smaller companies, which are less diversified. So if you want to get that exposure to, German construction or to the Chinese like travel trend, or you can do that through some of these not necessarily small, but like more mid-cap, like sizable, like market leaders in their niche, but not necessarily
local.
like trillion-dollar market cap company. So yeah, I think there's that. And on your point around multinationals versus more local companies, this is something that it appears that there is that maybe continued headwind on deglobalization is a big word, but more barriers to either like tariffs, but also, as you mentioned, like we just saw like a few days ago, like the U.S. administration wanting 15% of NVIDIA's and AMD's sales of chips to China. And this morning, China says no, like Chinese companies aren't allowed to buy those chips, which
So
they're
there's
getting
walls
closer
going
to.
up there. Yeah.
So
exactly.
That's a great way to describe
There's
it.
walls.
The walls are going up, tariffs or other, which makes it potentially more challenging for companies that derives a lot of their profitability from operations overseas. So I wouldn't say it's a direct consequence of that, the way the portfolios I manage are positioned, but this is the thought in the background that just raises the bar a little bit for me to get excited about a multinational that will likely have to deal with all these kinds of issues going forward. If it's in the price, that's fine. I'm okay. I'm contrarian. I'm willing to go against the tide, but it needs to be in the price. I'm not sure it's in the price yet.
Okay, that's so interesting. Yeah. So how would you close out and sort of wrap up the diversification piece of what your funds offer to, I mean, we're essentially back to narrow concentrated markets in the U.S., actually. That's sort of where we're back to. What do your funds and your style of investing offer on the other side as a closing remark?
I think I'll leave it a little bit to what we discuss. I think we might be, I can't guarantee it, but it appears we might be at that inflection point where that decade of U.S. exceptionalism is looking peakish, while the rest of the world may have, I think you need to be selective. I think there are loads of opportunities. Those markets are not overpriced in aggregate. Fundamentals have the potential to get better. Capital has the potential to continue to flow back. So yes, I am optimistic on the relative basis on international markets more so than North America. Then I think we'll need to, again, depending on your time horizon, but I think we need to ask ourselves, is there too much concentration in that narrow part of the market that becomes at risk, especially like on the AI hardware infrastructure build? That is a lot of market cap, that has a lot of correlation with meme stocks, with cryptocurrencies, with everything that the retail investor typically touches. All of that, if it unfolds, all of that unfolds. And there's no valuation support like anywhere in sight. So I think the international benefit is not only to capture potential opportunities, but I think also plays a role in potentially protecting you against what I think will be an eventual reversal of that melt up that we've seen. And I think to do it in a more like contrarian way, not only in terms of geographies and sectors, but also in terms of style. I think none of that has really worked in a big way for a very long time. We're starting to see signs that this is starting to work a little bit better. But if we are truly at this point, and that's what I'm positioned for, so you can read it for what it's worth.
Yeah.
I think it has a long way to go, and people will really change their view of what portfolio allocations they may want to have. And just try not to do it when it's too late. It will be my message, because the tendency is to react on the late side as opposed to being proactive. And I'm all about being proactive on the other side, even at the cost of being a little bit early sometimes.
It's fascinating to hear you discuss what we might be at the beginning of. Thank you so much for your time today.
Yeah, thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.